love the channel and find it useful in becoming a happy retiree. Subscribe today. Sheila joins us from Atlanta. Sheila, what's going on? How can I help?
Good morning. I'm a 71-year-old retiree, and I have my 100% in equity with Vanguard, and I know it's time for me to reallocate right now.
Is it time because you are 71 and you feel like that's an awful lot in the stock market?
Yes.
Sheila, tell me a little bit more about yourself. Are you living on this money from your IRA? Do you have a pension? You're probably taking some Social Security. Tell me a little bit more.
I do have Social Security. I have a pension, and I basically take the money for my RMD.
And for living, so you're spending your RMD money.
Yes.
Got it. And the reason I ask that, if you're saying, of course, Wes, of course she's spending the RMD, but some folks try to delay and they don't want to take the RMD because what it's going to do is it's going to increase their overall taxes, and they might not, let's say, need the money that year. The government still forces you to pull that money out. And if you don't take your RMD, which amounts to anywhere from about 4% to upwards of 5, 6, 7%, depending on your age, of the balance of your IRA. So if it's $100,000, it's going to be $4,000 or $5,000 a year that you have to take out. And if you don't do it, it's a steep penalty. It's a 50% penalty. So we're talking about this age-old conundrum that presents itself in a variety of ways, and that is, here we are with the Dow at a new high level, or bouncing right around a new high level. And it's been that way for a very long time as we've continued to plow new ground. And the worry, of course, is that here we are, always nervous about what's happening on Capitol Hill, what's happening in Washington. The government shuts down. How long is it going to take to reopen? We've seen this song and dance many, many times before. But it's a constant reminder of the vulnerability of the political system and then how that impacts economics. And we know those two are, of course, highly interrelated. And the question for you as an investor is, what side of the fence do you sit on? Are we at the end of our rope? Are the good times behind us? And where do we head from here? And that's this debate that we've been talking about here. I played a clip earlier, and I want to get back to that, but it plays right into the question that Sheila from Southwest Atlanta joins us. So Sheila, did you hang on the line with me?
Yes, I'm still here, and I also want to say I'm looking at Vanguard Total Bond Market Fund.
Yes, ma'am.
The Total Bond Market International, or the Target Retirement 2015.
Okay, so those are the other things you're considering. So let's refresh. So if you're just tuning in to Money Matters, we are on the line with Sheila from Southwest Atlanta. And Sheila is a little bit nervous because you've got your entire IRA in stock, basically.
Yes.
Is it all, what fund is it within Vanguard?
I have it in the dividend appreciation and the 500 index fund.
Got it. Which are wonderful. Those have been wonderful. They've been fantastic funds.
Yes.
And I love dividend appreciation. We've talked about it on the show many times because of the very nature of the kind of equity that it has. It's not just the S&P 500. It has a particular focus on companies that have an income stream, and that income stream can ratchet ever so slightly higher year after year after year. And that's a very good sign in a lot of ways for the company, and it's translated well for investors because these companies have the economic health and the balance sheet to be able to ratchet up the dividend that they pay out to investors. So that's part of why that story's worked so well. But now the question here is, as you are now in your 70s, you're taking your required minimum distribution, you start to get a lot more nervous about, well, what happens when the market does finally go into that correction phase?
Right.
What happens when we're at the end of that cycle? And that's the debate. I don't know if that's why you called, Sheila, if you've been listening to what we've been talking about earlier, this debate between these two heavyweight financial analysts that we're trying to decode today here on the show. I go back to looking at your particular situation, and I say, well, everything you have is wrapped up in equity markets. And that's great if you're 25. And it's maybe great even if you're 45. because you still have a lot of years to get to retirement. But usually, when you get into your later 50s, your early retirement, let's say your early 60s, and then where you are in your early 70s, you start to try to understand, or you start to try to take on a little bit more caution, and without giving up the farm and sitting, burying cash in the backyard under the mattress. My answer is always goes back to balance. I want to have some sort of balance, and I want to own a piece of my overall portfolio that doesn't go down by 30% when the market corrects. And that's why you've got to enter in some of these other choices. So you mentioned Vanguard, you said total bond.
Yes.
And what was the other one?
The total bond market international and the target retirement 2015.
So right out of the gate, I would be very careful about the total bond market international. The reason there, Sheila, is that we've got interest rates in the United States are starting to go up, and we saw a pretty big move in the last couple of weeks. What's interesting is that if you go internationally, if you look at Asia, look at Japan, you look at the European countries, Germany, you see interest rates that are far, far below where they are here in the United States, which means that you get virtually zero yield, and in some countries you actually get a negative yield. Okay. So to have an international bond fund right now, as global interest rates are starting to go up, could be a real issue. So I think that's one that I would probably stay very far away from.
Okay.
I would definitely not look at that. I would look at something in line with what that target fund that you talked about.
Okay.
I do like the Vanguard target funds. I think that they can make a lot of sense. I would have you look at another option that could. Well, first of all, I don't think you go wrong with the Vanguard target funds. Okay. So if you do a Vanguard target fund, I think you want to try to get around at least 40%, at least a third up to 40% in that area that's a little more protected, right? So that effectively would enter in the bond side of the equation, and that would so the target date fund would do that. If I look up your target date fund, Vanguard target, and what year were you looking at?
2015.
All right, target 2015, which again, it's almost as though that was a few years ago.
Right.
But it's been working, and that particular fund, if I look at that has about 60% in bonds. So so then all of a sudden if you do that, now you're going the entire different direction. And if you were to look at that fund, the one thing about these target funds is, again, you don't necessarily have a ton of control over, you don't have any control over the asset classes. That's why you're going to look at what makes up the target before you invest in it. This one also is about 15% in the international bond space, which again, I don't love. It's one of the things I don't necessarily love about these target funds is they're very, very heavy international. Heavy international stock, heavy international bond. And not that international on the stock side is a bad thing. I think international on the bond side is something that I personally like to stay away from. So I would steer you to look at another fund, and that would be the Vanguard Balanced Index Fund. And that has about 60% stocks. So that would reduce your allocation by about 40%. The other 40 goes into their version of fixed income or their version of bonds.
Okay.
Mostly government and mostly really high quality AA, AAA bonds. And I like that because there's a lot of quality there. And that's why you own bonds right now. You want to have the stability to pad if and when markets start to go the other direction, the stock side of the market. So for somebody that's been comfortable in stocks for now, how many years have you been all stock, Sheila?
I guess it's been about 10 years now.
It's a long time, and you've had a good run, right?
Right. I've been listening to you for more than 10 years.
Wow.
Well, as Mike. So.
Oh, wow. That's a long time.
Yes.
So with that, I think now is a good time to reassess and say, wow, I've had a great run. It's been all stock. I'm not as comfortable as I used to be with the fluctuations. So I would be looking at rebalancing to something more like a Vanguard, balanced because of the way they do it it's more of a static allocation. They always try to keep around that same balance. And they're really trying to find the best avenues as opposed to the target date funds that are kind of set it and forget it. They don't really change the, if you buy the 2015, you're going to have a big chunk in international bonds for a very long time, and I'm not a huge fan of that. So that's the direction I would steer you, Sheila. It's a word. And by the way, thank you for your call, and have a blessed rest of your Sunday.
You're welcome. It's the same to you.
Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.